Fraser Logistics and Commercial Trust is an interesting REIT with very good performing properties, but their dividends and share price continues to drop. We will look into what lessons can we learn and why their dividends are expected to continue dropping, and is it a good buy now? We will also briefly go through the earnings of OUE Reit and ESR Reit earnings to see how they are performing as compared to Fraser L&C Trust. Welcome back to another video where I analyze on Singapore dividend stocks. And let's get right into it. For people who are not familiar with FLCT, they are a REIT which has 72% logistic properties, which makes them very attractive as compared to most REITs due to the high demand for logistic properties. You can also watch my previous video here where I talk more about Fraser L&C's properties. Debts continues to be the main problem for Fraser L&C Trust. Leverage ratio actually went up from 33% to 36.2%, while their cost of debt has increased steadily from 2.8% of last year to 3.1%. If we compare with the last quarter's results, there are additional 153 million of debts added on to the financial year of 2025 debt maturity. With 709 million expiring this financial year, I expect their borrowing costs to continue increasing. This will definitely lead to higher finance costs. If we see their full year 2024 result, it's expected as their finance costs increased by an astonishing 46% year over year. With higher finance costs, their distributable income to shareholders are expected to drop if their income cannot grow as fast. Moreover, with higher cost of debt, lower interest coverage ratio will be expected. This is why in a high interest rate environment, it's important for investors to take note of the debt maturity profiles of the REIT. REITs with lots of debts to refinance during this high interest period will be impacted unless they are able to compensate with higher growth in their income like Keppel DC REIT. REITs tenants' leases income determines the revenue that the REITs can receive. Having lease rental reversion positive of 8 to 10% is good, while having negative rental reversions is obviously bad because new leases will give lower income. For Fraser L&C, they have very good positive rental reversions of 21.3% for 8 leases with square meter of 126,000. Commercial leases are not doing well with negative 9% rental reversion. Even though there is a lot of leases, the square meter is less compared to logistics. The main problem for Fraser L&C can be seen from the few important parameters. If we see their full year of 2024 result, revenue increased by 8.1%, while property operating expenses increased by 21.1%. Even though the net property income is higher, the additional expenses from the finance cost is the biggest problem, increasing 46.1%. Because of the finance costs, their distributable income dropped from 131 million to 124 million comparing the second half of the year. This is why Fraser L&C reported lower dividends of 3.32 cents from 3.52 cents. Sadly, with the large amount of debts that needs to be refinanced, I will not be surprised if their dividends continues to drop. This is one of the reasons why I sold it back when the interest rate was low and why their share price has dropped significantly from 2022. With such a big difference in lease performances, investors should favor REITs to have leases with good positive rental reversions to be expiring as they can be renewed at a higher income, while negative rental reversion leases are not desired for them to be expiring. For this case, for full year of 2025, 3.7% of the lease are logistics, while 5.6% leases are commercial. This is not good as most of the leases expiring will be either the 0 or the negative percentage mark because of the commercial leases. This might pose a risk for the growth in income for FLCT for this year. So what are the problems that FLCT currently faces? The biggest one will be the refinancing of the significant amount of full year 2025 debts that will continue to bring up their finance costs. This will be the main problem that will bring down their dividends. Next, with more commercial leases expiring, this might affect the income for FLCT. Even though it has dropped from the 41% high back in 2021, its current dividend yield of 7.3% might be expected to continue dropping. So REITs with good properties does not mean that they will do well. If their debts are not managed well in this high interest rate environment, their finance costs will continue to increase and bring down their dividends. Next, let us have a brief analysis of OUE Reit's results. OUE Reit is a small REIT that contains just 6 properties in Singapore, but these 6 properties are decent quality ones such as One Raffles Place, Hilton Singapore Orchard and Mandarin Gallery. Previously, they have sold the underwhelming asset of Lippo Plaza in Shanghai for 263 million, which now means that the REIT is 100% Singapore properties. If we look at their key highlights, revenue increased but net property income dropped. Distributable income and DPU for second half of 2024 increased by 8% year over year, while it's down 1.4% for the full year. We will take a look into why it's so later. The bottom portion is the important parameters for the 3 industries that OUE Reit's properties are in. Office properties have healthy occupancy and high rental reversion of 10.7%. Hospitality section, which is hotels, experienced higher revenue per available room of 9.2%, while retail achieved amazing positive rental reversion of 19.8%. This shows the quality of the SG properties that OUE Reit has. If we look in depth into the balance sheet, the surprising thing is that even with the sale of Lippo Plaza, I was expecting them to use the funds to pay down the debts. Based on the first look, it seems that they didn't really do that. What stands out the most is the share of joint venture results. It increased by 105% due to fair value gains with its partner. However, this increase might be unsustainable and we will see in the next quarter. Moreover, this half's dividend was slightly inflated with additional 2.5 million of capital distribution from divestment of 50% ownership of OUE Bayfront. Debt-wise, it's quite high at 39.9% leverage ratio, and since it's a small REIT, changes in valuation of the 6 properties will significantly impact their assets and thus their leverage ratio. For this financial year, they have no problems, but the big one will be in 2026 where they have a huge amount of debts that needs to be refinanced. So what can we conclude from OUE Reit's results? OUE Reit's overall properties are performing well across the board. However, the only risk is the high leverage ratio and their finance costs might continue to increase, which is risky for smaller REITs. At the current share price, its dividend yield is of 7.7%. The next week will be ESR Reit as someone has requested for it. Even though ESR Reit has a very low share price, its REIT is actually quite big. They are a REIT with 72 properties, with Singapore holding majority of the assets at 83.7%, Australia at 10.7%, while Japan is at 5.6%. What I like about them is that they have majority of their properties in the logistics sectors, which tends to do better in most countries. Looking at their key highlights, both revenue and NPI is down 4% year over year, with their dividends expected to drop. We can see from their breakdown, loss of revenue and income was due to the divestment of assets and decommissioning of a building. This led to lower distributable income of 6.4%, but their DPU actually dropped by 17.4% year over year. Why? It's because not only were their income lower, they also did equity fundraising, which increases the number of units and thus diluting the shareholders. Looking at their portfolio updates, rental reversion is very healthy at 10.3%, while occupancy is at 92%. On the bright side, their rental reversions across the portfolio is doing well, with high-spec industries and logistics being the outstanding ones. With such a good rental reversion rates, they have lots of lease expiring, with logistics holding quite a good portion of 54%. This will definitely benefit ESR Logo's REIT upcoming results. They have also been quite active with their divestment and acquisition, which they expect to be 3% positive DPU accretive. Now, going on to the debts their leverage ratio is actually at a high level of 42.8%, which to me is very risky. Their gross debt significantly increased due to acquisitions. On top of that, they actually have quite a chunk of perpetual securities as well, which resulted in a lower adjusted interest coverage ratio of just 2.5 times. But the good news is that their cost of debts are actually falling. They mentioned that the early refinancing has resulted in lower margins, therefore able to bring down the portfolio's cost of debt from 4.03% to 3.84%. Moreover, they mentioned that the early refinancing of the debts in 2026 might potentially result in additional lowering of the cost of debts as well. Like I've mentioned, REITs, which currently has very high cost of debts, might start seeing this value drop for their new refinancing. This will definitely benefit those REITs and the shareholders. So what can we conclude from this quick analysis? Properties of ESR REITs are doing well with good occupancy and high rental reversions. The second good point is that the cost of debts will go down, which is definitely a good thing for a REIT. However, because of the acquisitions, gross of debt has increased by a lot. This brings risk as their leverage ratio is at 42.3% on top of the 400 million of perpetual securities. This will continue to rack up more finance costs due to the additional debts, and in the future, they have not much headroom for additional acquisitions unless they get the money from the shareholders. At the current share price, its dividend yield is around 10%, but do take note of the risk that is involved and why their dividend yields are so high. All in all, the three REITs are currently experiencing drops in dividends with each having their own risks. I hope this analysis video helps you in your investment journey, and just looking at the low share price will not justify the performance in the future. Thank you so much for watching. Please support the channel by hitting the like, subscribe, and comment on any topics that you would like me to work on next. You can also support the channel by looking at the affiliate links below to register for your investment brokers. There are also other bank stocks and blue chip REITs that I've actually analysed on which are currently performing better here. Thank you, and I'll see you in the next video.